Hi, Nick Colas from DataTrek here, and the title of today's video is Know Your Options. We'll be discussing at a high level the U.S. listed equity options market, how it works, how these products price, and some use cases that investors might be interested in looking at in the current kind of uncertain environment. Let's start with a little bit of background though. The most important thing to understand about options is that they're significantly more complex and riskier than simply buying and holding U.S. stocks. Many or most, depending on the study that I've seen, equity options expire worthless. Estimates go from between 30 and 40% to as much as 90%. But U.S. equities have a really solid long-term track record of compounding at 9 to 11%. So most options expire worthless, but stocks over time do very well. And that's really important to understand. A couple of definitions and how these things price before we move on to a deeper dive discussion. A call option is the right to buy a security at a preset price up to a certain day. A put option is the opposite. It's the right to sell a security at a preset price up to a certain day. And the prices we'll be discussing in this video, one contract represents 100 shares, but the price is quoted per share. So you'll see how that works in a second. Now let's talk about some basic issues. What actually creates the price of an option? And here we're going to use the Black-Scholes options pricing model, which has been around since the 1970s and still the gold standard for understanding how options get priced. 4 factors in an options price are observable: the time to expiration, so how long the option lasts; the strike price, meaning where do you get to buy or sell; interest rates, which are not usually a factor, but were in the 70s and 80s when these products really first started gaining in popularity. And then obviously the changing value of the underlying security. As the underlying security goes up or down, the price of the option goes up or down. So far we can look these all up in the newspaper or online, and we know what they are. There is one, however, piece of the puzzle which we can't observe directly, and that is expected future volatility. So when you plug all these other factors into a Black-Scholes pricing model, the remainder is implied volatility. And that might sound very technical and very hard to understand, but it's basically how much the market expects that security to go up or down between now and the expiration of the option. There's a really simple example here that I think is really useful for helping understand this model, and that's the CBOE Volatility Index, or the VIX, measures expected 30-day forward volatility on the S&P. It is that missing piece of the Black-Scholes model, and we use it every day. And we kind of understand what it means. When the VIX is going up, we know markets are getting fearful. Implied volatility, expected volatility is rising. Conversely, when markets start to calm down, expected volatility declines. So that's a good way to think about how options get priced. It's the combination of a bunch of things we can observe and one thing that's more of a feel, and that is whether you think volatility is rising or falling or going to stay roughly the same. But those are the things that price options. Now let's take these kind of esoteric points and bring them home with a couple of examples. Example number 1. NVIDIA trades for about $119 a share today. If you wanted to buy a $130 strike call expiring in mid-May, that would cost you about $7. So $7 on $119. Okay. Now, if you wanted to buy a 130 strike call expiring in December, another many months forward, that would cost you $18, so more than twice as much. So the time value of that option adds a lot to the price. If you extend the time, the price goes up. Or if you shorten the time, the price goes down. So that gives you a sense of how time affects options prices. The next example is the relative value of different strike prices. And here we'll use the S&P 500 or the SPY, the spiders. They trade for about $591 a share today. If you wanted to buy a call 10% higher, that would cost you $13.47. However, if you wanted to buy a call 20% higher, meaning you're only going to make money if the market rallies 20% between now and the rest of the year, that would cost you only $2. So you can see that the market is saying, yeah, we got a pretty good shot of being 10% higher by year end, by December. We don't have that good a shot of being up 20% over the rest of the year. And that makes a lot of sense. As you go out into higher strike prices on a call, you're going to pay less, but the odds that you're going to expire worthless are going to increase because you're increasingly betting on much less likely options. Now let's also look at the difference between upside and downside exposure. So a call gives you upside exposure, a put gives you downside protection. If you wanted to buy some protection against the S&P declining by 20%, so down to about 470 on the spiders, that would cost you $7.20 right now. That's 3 times more than the 20% upside call. So you get a sense that options prices are not linear. They're not even on both sides. The cost of protection, the cost of insurance is much higher than playing for the upside. And that makes sense. There should be more demand for downside protection. Now that leads us to our use cases for today. Because as I've tried to outline to you, options trading is not for the faint of heart, and it's not for folks who don't like or understand math, because there's a lot of math in options trading. So you have to be comfortable with that math and understand the different levers: time, volatility, strike prices. Those are all things that you have to think about. It's a much more multivariate conversation than just, do I like this stock or do I not like this stock, and will it work out over time? So a couple of use cases. Let's say you're nervous about a stock market crash. And frankly, we hear this a lot from clients right now, that there's a lot of nervousness in the market. So how do you protect yourself against a over 20% decline in the stock market between, say, now and the end of the year? And the answer is you buy a put. We discussed this in the prior slide. Buying a put with a 475 strike on the spiders expiring in December costs $7.20. That's 1.2% of an S&P share. If the market suddenly begins to drop quickly, this option is going to protect you against some loss. Not all, obviously, because if it goes down 10%, you're still not in the money. But if the market does go through some kind of cataclysm and you're down more than 20%, then this put option stops out your losses at 20% through year end. The cost of that is, if these options never come into the money and they expire worthless, it'll cost you about 1.2% of portfolio performance, which is why not a lot of professional money managers use these products to protect against big downside moves. But as an individual investor or as a registered investment advisor looking to make sure that you got your client's best interest covered, a put option might make sense for clients that are really worried about the current market conditions. So that's one option, no pun intended. The next idea is, if you think we're stuck in a trading band between now through June, and that's entirely possible, how do you make a little bit of money leveraging that idea? And you might want to consider selling some call options against your underlying spider or S&P position. If you sell one 655 call, 10% higher than here, expiring in June, so you're going to get $1.66. Now, this is not going to protect you against big downside losses, but it will give you a little bit of income if your idea is right and the market kind of stays in the current environment and never breaks 10% higher and stays there. So there is a way to make a little bit of coupon, a little bit of money, a little bit of a dividend, if you will, from the idea of selling a call option into a kind of choppy but trendless tape. So a couple of takeaways here. And just to reiterate, a lot can go wrong in trading options because they're so much more complex than stocks. Most investors should therefore, I think, really limit their use of options to truly useful applications that help them stay invested for the long term. And those are the two examples I gave you. One gives you some peace of mind because you don't have to worry about a cataclysm in stocks and being down more than 20% on the year, which would be horrible, obviously. And it might allow you a little bit of extra income in case you think the market's going to be range bound and you're not going to be making a lot over the near term. So if you're worried about where the market is today, both examples we gave, I think, can really help you. So with that, I'd like to say thank you for watching this video. If you enjoyed it, please hit like and subscribe. And if you're interested in more work from DataTrek, please go check out DataTrekResearch.com and sign up for a 2-week free trial. With that, thank you again so much for listening and watching, and have a great day. Thank you.